Good morning, everyone. The market's paying attention to what central banks say, not to the data. U.S. jobless claims fell sharply yesterday, bringing the 4-week moving average down to a new low for this economic cycle. Nonetheless, the fallout from Wednesday's FOMC minutes predominated, and Fed funds rates expectations simply collapsed 10 basis points in the long end. The stock market rout spread from the tech and social media to the broader market, and the S&P 500 index fell 2.1% to be down for the year, dragging 10-year Treasury yields down 4 basis points, and the dollar generally weakened. It's off its lows, actually gaining against half its G10 counterparts and many EM currencies, but the result is clear. The market's focusing on what the FOMC says, not on what the numbers imply. Even the Wall Street Journal, which is hardly a left-wing conspiracy publication, said, quote, "Financial markets are enthralled to central banks rather than caring about the health of the economy," unquote. Similarly, the market seems to be ignoring the Eurozone data as well. Yesterday saw a slew of Eurozone CPIs for March released. They were generally lower, some flirting with or moving deeper into deflation. Only Ireland saw its rate of inflation accelerate. This makes it harder for the ECB to claim that below target inflation in the region is just a technical matter. I still believe that eventually the ECB will have to ease policy further, which should provide a leg down for eurodollar. However, it's clear that the ECB has a greater tolerance for below target inflation than I had thought, and this is likely to take longer than expected. If the April inflation data due out on April 30th doesn't show any rise in inflation, that may cause more verbal intervention, at least from the ECB. But it could take a political jolt from the May elections to focus the Council's mind on the need to promote growth. Either that, or perhaps the 40,000 Russian troops massing on the Ukrainian border will eventually change their way of thinking. Same in Japan, too. I expect the Bank of Japan to come in with another round of easing later this year as the economy slows. Nonetheless, there too, the Bank of Japan seems relatively confident in its current path and is in no hurry to change course. We'll probably have to wait some time there as well before the authorities decide that they need to add to their stimulus. As for today, there's a light economic calendar. The only indicator left at this point to come out is the U.S. PPI for March and the University of Michigan Consumer Sentiment for April. The U of M index is expected to rise slightly, which could support the dollar a bit. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.